All right, guys, welcome back to the channel. Wanted to do a video today updating people on yesterday's events in the stock market. I actually wanted to film yesterday, but I had the craziest day, not related to the stock market, actually. It's relating to a cash out refinance that I've discussed um, previously here. And the idea is to take some of that cash out refinance money and to deploy those in my quantitative strategies that I built in Composer, but just having some 11th hour hiccups with that, on permits and insurance stuff. So just trying to, get everything situated there. And then as I was doing all that, I'm seeing that the stock market was down massively yesterday. A viewer actually messaged me on Instagram and had some questions, so I figured I'd pop on camera here and do a little video today. Yesterday made me think of this quotation. I believe it's called chaos theory and science, and it's: a butterfly can flutter its wings over a flower in China and cause a hurricane in the Caribbean. Well, yesterday would be a little edit of that, and it would be what a Chinese property developer in China can threaten to default on its debt and cause a hurricane in the American financial markets, right? So that's what you saw yesterday. It seems like, I think maybe people are thinking like in 2008 in America when you had the financial contagion, the interconnectedness between different banks and lenders and such. And if Evergrande has, I think they're saying 300 billion of debt, well, who holds that debt? And if it's Chinese banks and lenders, then they're under threat as well, just kind of like sort of what happened in 2008. So there was this sense of, oh, is this going to be like a huge deal in China, which is going to reverberate across Chinese markets and global markets? So you had that big sell-off. At one point, I think the Dow was down 900 points. It recovered a little bit in the end. It was down 600 points or so. But it's a good learning experience. So what I want to do now is I want to shift to TD Ameritrade here. And this is geared for everyone, but maybe especially younger investors. As you invest and as you develop capital and accumulate capital, one of the things that you're going to have to learn, the skills that you're going to have to learn is the ability to deal with volatility. And novice investors or people that are just newer to money struggle oftentimes dealing with volatility. And I think because they have a working class, a wage earning, a W-2 mentality. And I don't mean to be a terrible snob when I say that necessarily, but what I'm trying to explain is that the ability to see accounts fluctuate and the ability, and I'm going to quote the late, great Jack Bogle here. He has two quotations I'm going to quote, actually. The first is stay the course. The second is he has this quotation where he would say, don't do something, just stand there. So let me say it again because you're used to hearing it the other way. Don't do something, just stand there. And in situations like this, even though Bogle's passed on, I could hear him almost from the grave saying, don't do something, just stand there. And, obviously a lot of people, in order to feel like they're engaged with their investments or they're taking action or whatever, how you want to describe it. Oh, I got to get out of this and get into this. And a lot of times just sitting on your hands can be the best thing you can do. Again, it makes me think of Fidelity's study where their best performing accounts were dead people and people who forgot they had an account, because they weren't constantly tinkering. But let me show you what I mean with volatility. So you can see here, and this is a month back. On September 2nd, this particular TD account had $651,503. Oh, let me do it again. $651,503.03. Okay. You can see here it's, it was a little volatility, a little bit it dropped a little bit here on the 10th, and then we got a bounce by the 13th. 14th, it's down. But then we see, this big drop here. So you see it went from 634 to 611. So let's take minus 611,438.01. Okay. So that number is $40,065. So between September 2nd and September 20th, which is 18 days. So in 18 days, my account here declined $40,000. For me, that's a non-issue. But for many of you maybe watching this video might be thinking, what are you talking about? For me, that's a half a year's salary, or it's a year's salary, or it's a quarter of a year's salary. You'll hear things like, oh, I worked hard for my money. No one ever handed me anything. I'm self-made. You'll hear all these kind of working class maxims. And that's why I always feel when you adopt an aristocratic pose, even if it's false, even if it's literally nothing more than a pose, you'll end up doing better than someone who holds on to those working class maxims, that holds on to every penny and can't see a $40,000 swing as nothing more than volatility. I mean, you just got to think, if this account were 10x, this is a $400,000 swing. So meaning if we're at 6 million, there's a $400,000 drop. If we're at 100x, you know what? We're at a $4 million swing, and that's just volatility. So you can imagine the portfolios of people like Berkshire and Blackstone and KKR and just wealthier individuals, wealthy institutions. They're going to have like maybe 100 million, if not billion-dollar volatility. So you need to be able to deal with like a $40,000 volatility or a $400,000 volatility. So I'm going to back it up and show you the power. And it's not just like, so I'm just giving you my opinion. You say, well, what if it keeps going down? Well, if it keeps going down, that's like the end of civilization, because the stock market from its inception has always recovered. Now, it might take a year, 2 years, 3 years. So if you don't have patience, that's another competitive advantage, is patience. It's not, to me, it's not a virtue, it's a competitive investing advantage. But let's back it up just so you can kind of see this here. So again, you can see, look what happened. This is March of 2020, and you can see that it was like 100 and some thousand drop. You can see, look, the drop I just showed you. Look, it's just a tiny little thing here, right? Versus this is the history of this particular TD account. You see the bump here, but again, and this is 2020. This little thing that's all that was, And so we're up today. I mean, I'll scroll up here and you can just see. Okay, so I was down at one point, maybe 20 or 30,000 yesterday. If I had panic sold, you can see that I'm missing this upswing. There's a stock market fact, and maybe one of the readers can pull it up, but it's like, if you miss the biggest 4 up days in the market, then you need to out compound by X. You can Google around and figure out what the X is, but if you're missing out on these big up days, oh look, it just went up to 8,000 there. Well, literally while we were at 7,000, it's up to 8. So let's just update 8. So we're up 8,000 today. But again, it's not like I'm selling and realizing this 8,000 profit. So I don't have that day trader, swing trader mentality. And the other thing is that the subscriber questioned the Chinese bank holdings. Like maybe they're thinking I'm going to sell out of those because of Evergrande. Those are state-owned banks, so I feel that's also an advantage here. I don't think the Chinese are going to want the press of their 4 state-owned banks going belly up. I think they're going to take whatever action they need to defend their state-owned banks. I mean, they're down a little bit. I have a Bank of China pulled up here, and this actually proves 2 points. So one, it showcases in Bank of China that I'm down a little bit. Now, it's showing that I'm down 2,600. That's actually not the case, and that's what I want to show here. And then it's going to prove the point that when you own oftentimes dividend-paying stocks, in market crashes, you're really going to get ahead because those stocks are continuing to pay dividends most times. So you're buying cheaper shares of that company. And then when you come out of that contagion, panic, crash, bear market, however you want to describe it, you've actually accumulated more in those particular instances because of the dividends. So it's showing Bank of China, my cost base is at 13.8, my value this down 26, but actually I'm almost flat. I think I may be down $500 even after yesterday where there's this big Evergrande thing. And this is what I'm going to show you. So I'm going to take, there's 3 purchases. This purchase here, 603, 637, 778 are all dividend reinvestment. So that's free manna from heaven. So I'm going to take the 805.65 the 10-012-27 and the 1,008.83. So my cost basis on Bank of China is 11,826. It's showing the value today at 11,243. So it's about 243 and 36 cents. So I'm down $583 in Bank of China, just to give you a sense. It proves that generally the longer you hold something in dividend payers, meaning the more times you have dividends come off and be reinvested and allow that compounding to take place, the better off you are. So yeah, I mean, you can see my cost basis in the beginning is 11, 10, 10, and it's 860 today, with what's going on with Evergrande and such. You can see this dividend here came off at, 829. It's still up. This was 886. It's down a little. But yeah, so that just kind of showcases Bank of China. So I'm basically flat, if you will, on this. So, I mean, we'll see. I don't mean to be like flippant about it. And then, Evergrande completely defaults and the Chinese banks crater. Could that happen? I'm not saying certainly, it's a possibility. There's risk. There's risk in investing. There's risk in making certain decisions. So we'll see. The fact that they're a dividend payer and the fact that they're state-owned, I view the state-owned element with the Chinese as kind of like Warren Buffett's moat. He talks about businesses having a moat. To me, the state-owned descriptor is something of a moat. So that's how I see it. And again, I could be completely wrong. Time will tell, but you can see the numbers here. You can see where I am. You can see that it's not like a massive drawdown there from yesterday. So anyways, guys, that's pretty much it for today. I got to get back to this loan. This is, again, a technique that I learned from Grant Cardone. As I mentioned before, I'm trying to finalize it. It's giving me a lot of stress. I'm not going to lie, but it's just the paperwork with the banks. It's just getting all the T's crossed and I's dotted. It's just a lot. And so, just trying to get it situated, but I'll keep you guys updated on that. We'll see if today's bounce is, the beginning of, kind of a stabilization, or are we going into a bear market? Are we going to take a 20% drop in the Dow? Time will tell. Hope you're all well. Appreciate the likes, comments, subscribes. Take care.